Nikhil Sawhney, Vice Chairman and Managing Director of Triveni Turbine, joins us now. And it is one company which everybody knows, but very few talks because he hardly comes on TV. That's the complaint. How do we address this problem? I'll talk about numbers, I'll talk about everything else. If you will be seen, then only people will recognize you and the good work you're doing. Let's address that problem first. Then we'll talk about other things.
No, you never take my interview actually, so you push me back to, no, that's not the reason. It's, but firstly, thank you very much and very good morning to you. Very happy to be here. I think it's better for our results to speak for itself. There's the expectations rise drastically as we come on TV. So, but I'm very happy to be here. Thank you.
Joining us. So let's talk numbers. If I have to introduce Triveni Turbine, I would like to introduce it as a specialized engineering company in a very niche kind of a category, and a category which is growing. Am I right in introducing the company?
If you permit me, let me augment that introduction a little bit. We are part of a very large market. We are part of an industrial heat and power market. And if you look at it from the perspective of energy consumption, 50% of end energy consumption is in the form of heating and cooling. And so we cater to, or we provide solutions for industrial power and heat market, which gives you an indication as to where our technological interventions and developments will go towards. At this point in time, we develop turbines and steam turbines for that requirement. And as you may have seen in our recent quarter, we've also developed carbon dioxide-based turbines. The point is that we use fluid dynamics and thermodynamics to develop solutions which can ultimately cater to our customers. The requirement, of course, is spread around a variety of industries. Historically, we've had renewable energy as being a mainstay for our order booking, but we've seen with in the recent past that the oil and gas market, API market, has picked up quite considerably. We also have niche demand coming from areas such as, recently in this current quarter for the small modular reactor market. But ultimately, we provide a product into a larger solution. Our endeavor in developing a carbon dioxide-based turbine was essentially to develop a product that could be part of a larger solution. This is part of, so we would develop a solution for long duration battery storage, energy storage, and that's what we've aimed to do here.
Okay.
Right. So Nikhil, tell me, let's try and analyze what the quarter gone by was and what the next fiscal actually throws up. Your PAT, your order booking, all of it seems to be at a record high. That's how you've finished last quarter. But tell me, going forward for FY26, what's the outlook for both the domestic as well as the export markets?
Thank you. Thank you for that question. Firstly, this is the 17th quarter of growth for the company. So we're very proud of that. Over the last 3 years, we've grown our revenue by over 2.3 times at a growth rate of 31% CAGR or 33% CAGR. And our profitability has grown by 41% CAGR, which has grown by about 2.8 times over the last 3 years. As of the 1st of April 2025, our order book stands at 21% higher than it did at the same time of the previous year. And at the same time, our order booking in the previous year was about 26% higher than FY24. So this has started off, it's given us a very good starting point for FY26, where we not only have a very strong order book, which we have to execute, but we will have book and bill within the current year as well. So we are in line to sort of continue with our growth rate that we have exhibited in the recent past. From a breakup of the domestic versus international market, we've seen a growth in our inquiry book, which is a foreteller of our order booking. Our export inquiry book has grown by about 30%, while our domestic order book has grown by about 120%. And this is quite encouraging given the fact that FY25 was quite weak for the Indian market in terms of demand, given some elections in the first couple of quarters and some uncertainty driven by geopolitics in Q4. So having said that, we're quite optimistic on the domestic market. We see demand coming through from a variety of different sectors. We're happy that the steel sector is coming back, given some safeguard duties have been imposed. The cement sector seems to be quite robust in its waste heat recovery, as well as greenfield and brownfield expansion. But we have newer sectors such as paper recycling and plastic recycling, which also give good confidence for a continued momentum of order booking in the domestic market.
So why are you growing at 20% suddenly? I mean, what has changed in terms of the market dynamics? Yeah. You were there in business You are in business, but suddenly the business is not growing, it is galloping. What has changed in these 17 quarters that you're growing so fast?
Well, essentially, Nikunj, what we have done is expanded our market size by entering into distinct areas which have expanded our outlook. We were traditionally a turbine manufacturer with a size of up to 30 megawatts, and we've historically had a very good market share in India as well as a decent market share internationally. Post-COVID, you had a spurt in fixed capital formation in commodity-based industries, which led to strengthening and expansion of that historical small market. At the same time, we developed turbines in a higher megawatt range, which allowed us to enter into that stream and expanded that market size quite considerably. While the growth in that larger range will happen in a more linear basis in terms of market share gain, it will happen as we are able to exhibit and show successful installations for our customers. We also have another growth driver, which is in the oil and gas market, which I spoke about, which is a market dominated by integrated oil and gas majors, where credentials and qualifications are a very important part of entering that market. As it so happens, over the last several years, we've been able to enter that and quite successfully. This provides us another growth engine. All of this is backed by, in the capital goods space, your aftermarket is the real foreteller of how successful you are, not only in terms of customer satisfaction, but it's really where the profitability of the business comes from. And that has also been growing quite rapidly with not only our historic spares and servicing for our installed base, but more so for our refurbishment market, which is what we do for third parties. This is an area where we are very optimistic on to be able to provide Indian engineering resources to global capital equipment problems. And we feel that the way to cover this is by actually being close to the customer. So we have a subsidiary strategy where we'd like to be close to our customers so that we can provide them the solutions that they require on the ground. And so we recently opened a subsidiary in the United States. We have one in South Africa. We have in the Middle East and Southeast Asia. But we're quite optimistic that these will be able to scale and continue our momentum in order booking and growth.
You know, while your order growth is admirable, your top line growth is admirable, but there are two numbers which markets and investors, they always look at. One is return on capital, that is ROCE. I have your March 24 numbers. I don't have the latest numbers. You'll have to give me the latest number. But the ratio has gone down from 21 to 15 in March 2024. For a business where Capex has happened, for a business where I would imagine that the expansion benefit should kick in, your ROCE should have naturally stayed above 20. It dropped in 2024. Has it improved in 2025? Will it improve in FY26?
Actually, I will take this up with you later, Nikunj, but our return on capital employed is in the region. For this current year, FY25 is 45%, and in last year was approximately 42%. If I actually take out cash from our book, our return on capital employed is in excess of 250%. We have an asset turnover of over 6, and we have a negative working capital cycle. So I will question you on the data that your analyst may have provided you.
I asked you because I knew that my assessment was wrong. Thank you for correcting me on air. There's nothing wrong that you've taught me something new today. Okay, now let's understand the benefits and how the structuring is done, because there is a visible slowdown in the so-called private sector Capex in India. Commodity boom, the best which we saw after COVID, that seems to be also hitting a base. Could next 3 years be not as great as the last 3 years? Because 3 years you enjoyed the benefit of rebuild India, rebuild the world, normalization post-COVID. Could that dream run stall?
Well, Nikunj, the way that I explain this to our investors is in the following manner. If I look at capital investment and fixed capital formation from the perspective of a business cycle, the last peak we saw in the ordering of steam turbines in the market below 100 megawatts was approximately 4,000 megawatts, and that was well back in 2011. At that point of time, and admittedly that was a peak, at that point in time, the Indian economy was approximately $1.3 trillion. At this current point in time, we're about $3.9 trillion as an economy. And at the same point in time, the market size was a little bit over 2,000 megawatts in terms of order, which is a 10% decline over last year. So having said that, in the medium term, while you will have aberrations and business cycles on a year-on-year basis, the trend is quite clearly that we have enough ample room to grow, given the capacity that needs to be fulfilled. To talk to your question in specific, the market degrew by about 10% last year because of lack of ordering in the first couple of quarters because of the political elections, as well as some uncertainty in Q4. But having said that, and I did point out, we've grown our inquiry book in the domestic market by about 120%. And when we talk about inquiries, these are not frivolous requests for quotations that come from customers. These are very technical documents, and so there's a lot of work that has gone into it. And in our assessment, financial closure for a lot of them are well underway. So we find that in the coming quarters, I think it would be back-ended actually into the second half of the current financial year. We should see good growth in the domestic market, driven by private sector Capex. You will also have government Capex happening in the fertilizer and oil and gas segments. And so all in all, we think that there will be good growth in the overall market for steam turbines in India.
Admit that I was careless. I was looking at numbers of not Triveni Turbine, Triveni Engineering. My bad. Yes, numbers for the year gone by. ROCE is 44%. So congratulations. 21 has become 44. Quite extraordinary.
Thank you.
Thank you very much, and hope to see much more of you going forward.
I look forward to it, Nikunj. Thank you very much for having me on.
If you like this video, then like, share and subscribe to ET Now.